Yield in the New Era, exploring blockchain-based interest mechanisms without traditional financial instruments. With global interest rates staying low and bonds offering less return, investors are turning to the blockchain. In this new financial world, yield doesn't come from banks or governments. It comes from code, smart contracts, and decentralized finance DeFi protocols. DeFi allows users to earn yield by lending, staking, or providing liquidity without middlemen. This system is open, automated, and runs 24/7 around the globe, from interest to incentives, reconstructing the foundations of yield. In traditional finance, you earn interest by lending money and charging borrowers. In blockchain finance, yield comes from incentives, rewards, and liquidity sharing. Take Aave and Compound, for example. Users lend digital assets into pools, and borrowers pay interest. Rates are based on supply and demand, not a central bank. When demand is high, lenders earn more. Platforms like GMX and Pendle take it further. They offer yield through trading fees or by splitting future yield from principal, enabling advanced strategies that aren't possible with regular bonds. The role of staking: passive yield with network security. Staking is a popular yield tool in blockchain, especially in proof-of-stake networks like Ethereum, Solana, and Cosmos. When users stake tokens, they help secure the network and earn rewards. With Ethereum's shift to proof-of-stake, staking has become a main yield strategy. Platforms like Lido Finance let users stake ETH and receive a token that they can still use in DeFi. Here, yield isn't earned by lending, but by supporting the blockchain's function and earning native token rewards. Smart contracts as autonomous yield engines. Smart contracts power DeFi's yield system. They control lending, borrowing, and rewards automatically and without human control. For example, MakerDAO lets users lock assets to mint DAI. Then, they can earn yield through the DAI savings rate, paid from the protocol's revenue. Risks, sustainability, and yield compression. Blockchain-based yields come with risks. Smart contract bugs, lack of regulation, and fast-changing rewards can create instability. Often, new projects offer high returns to attract users, but these yields can drop once token rewards end. That's why the market is shifting toward more stable, sustainable yields based on trading fees or real borrowing demand. Stablecoin lending in real-world assets, RWAs, decentralized finance, DeFi, is evolving beyond crypto-only ecosystems and starting to connect directly with traditional finance. One of the most promising developments is the integration of real-world assets, RWAs, such as business loans, invoices, and physical goods, into DeFi lending platforms. Projects like Maple Finance, Centrifuge, and Goldfinch now allow users to lend stablecoins, cryptocurrencies pegged to fiat currencies like the US dollar, to real-world businesses. These loans are backed by legally binding agreements, invoices, and off-chain assets, rather than just crypto collateral. In return, users earn a predictable yield, similar to interest income, but with more transparency and global reach. Stablecoin lending is still one of DeFi's most widely used applications. In traditional models, borrowers often over-collateralize, meaning they deposit more in crypto value than they borrow in stablecoins. This helps protect lenders against price volatility and default risk, making returns relatively stable. What makes RWAs exciting is the ability to unlock new sources of yield that are tied to real economic activity, not just crypto speculation. For example, a business in need of working capital can receive a stablecoin loan based on expected future revenue, while investors globally can participate in that financing through tokenized lending pools. This new model of lending bridges decentralized technology with real-world needs. It creates value for both sides. Businesses get flexible funding, and investors earn yield that is grounded in real performance and enforceable legal contracts. A market without borders, permission, or banks. DeFi is open to anyone, anywhere. No bank accounts, no credit scores, just a smartphone and a wallet. It offers real-time payments, programmable income, and full transparency, something traditional finance can't match. Reimagine yield with Kensen Investments. This is more than a trend, it's the future of income. With Kensen Investments, explore blockchain-based yield strategies that are smart, secure, and sustainable. Let us help you move beyond traditional finance and build the next version of your portfolio.